If you've been following crypto, you'll be familiar with a recent crisis emerging from a certain centralized exchange, but the traditional media has been painting this story as a failure of DeFi. They're not the same, and here we'll tell you why. Exchanges have been an important part of the financial markets since 1611, when the first modern stock trading exchange was created in Amsterdam, trading exclusively Dutch East India Company for many years. They are marketplaces facilitating trade between companies and investors of various asset classes in a fair and ordered manner, efficiently distributing information about the assets being traded. Once a place where traders went to negotiate, modern exchanges have evolved into powerful websites where brokers connect digitally and bots help them gain an edge. When it comes to crypto, there are two major types of exchanges where traders and investors can negotiate their digital assets: centralized and decentralized exchanges. Centralized exchanges provide trading services using traditional technology like websites and logins, abstracting the interaction between the trader and the underlying blockchain. They can offer a selection of digital assets for spot purchase, serving as the on-ramp for traditional money. You should check out our Explorers video on on-ramping to get up to speed. Centralized exchanges hold funds on behalf of the clients. For that reason, these are considered custodial services. A decentralized exchange can either be a company or a DAO, a decentralized autonomous organization, that provides the infrastructure with smart contracts, allowing traders to interact directly with the blockchain to exchange tokens. They also offer different instruments around the trader digital assets, such as derivatives, futures, options, and perpetual contracts, where there are no expiration dates as long as the trader continues to pay for the servicing fee, lending, borrowing, and even stablecoin issuance. Decentralized exchanges usually don't accept fiat money and don't have custody of investor funds. These are considered non-custodial services. DEXs work based on liquidity providers, which can operate using two different methods provided by the DEX: automated market maker or order book. In the order book method, users submit buy and sell orders. The liquidity providers then choose which of them they will match and exchange one asset for another. This method maximizes the return of liquidity providers as it facilitates choice, but it's a process-heavy method that usually isn't automated. In the AMM method, liquidity providers deposit their tokens into liquidity pools. Users that want to trade post their orders, and the algorithm does the exchange automatically. This is an automated and more efficient process, but can expose the liquidity providers to something called impermanent loss. Impermanent loss is when a token's price change causes your share in a liquidity pool to be worth less than the present value of your deposit. If you want to buy your first crypto, centralized exchanges have the lowest barrier to entry because they can accept your fiat deposits and then let you buy your crypto of choice. After this, you can send your assets to your desired self-custodial wallet and then proceed to connect with a DEX and trade to other tokens. Transparency. Because they use traditional technology to interact with the blockchain, centralized exchanges lack transparency. Yes, it's possible to see the resulting transactions on the blockchain, but not at the atomic level. With DEXs, every transaction, as small as they are, can be traced into the blockchain. Anonymity. DEXs require you to connect your Web3 wallet, but won't necessarily run a KYC process. That preserves the investor's anonymity and can be a problem for most regulators, as Web3 wallets are pseudonymous. Custody. Again, centralized exchanges are custodial services, which can mean at times that issues with those services could wipe out user funds. DEXs are non-custodial, which means that users must be their own bank. This is still hard work if you're not familiar with the risks and challenges. Well, first, it's because we don't want you to misread the news. Centralized exchanges are not DeFi. They're CeFi, centralized finance, and should be regulated as such. Also, DeFi is the ultimate fintech, financial technology. It's where financial services are truly digital. So if you are a fintech builder, you might want to explore DeFi as an alternative. This is absolutely the window to learn, experiment, build, and help shape the future of finance. And we hope to see more people interested in this. We can even help you build it. In the meantime, stay rare, stay weird. LFG.